Hi, in this video I'm going to talk about the order of investment for perhaps for early retirement and not having to wait till the traditional age of 67 or higher. So, hi, I'm Felicia. If you're new to my channel, I'm a former actuary. I'm here to, in this channel I talk about things like mindset and money and wealth creation. So today I'm going to talk about the order of investment one can consider, and I'm not a financial advisor. I'm just here as a financial educator to share tips and I've used to get to the position of early retirement. So the order of investment is emergency fund. Many people talk about having enough, maybe 3, 6, 12 months of money set aside for emergency, like a broken boiler, a car that's packed in early, sooner than later. So money into emergency fund, and then perhaps you can put that into interest account, high interest account, or sometimes you can put it. I put my emergency fund into a premium bond with the National Savings Account (NSI), and that gives you potentially to win £1 million. And if you do win, the winnings or the monthly winnings are tax free. So that is lodged away into premium bonds. That's my emergency fund. And if you've got things, and then the next stage would be to build up to see if you've got any debt, high interest debt, not mortgages or student loans, but high interest debt, credit card debt, where you're paying up to 29%. By paying that off, that's immediately 29, or that rate of interest, return on your money invested. So there's two different ways of doing that. There's like the avalanche way and the snowball effect, and so one attacks the smallest debt and pay that off, and it's going to incentivize you to start paying the rest off, or just attack the highest debt interest rate and then bring that down. That's mathematically more efficient way of doing it, but they're both, both is just use either way that suits you, and just get rid of those debt, because that's a really good return on your money invested, money return, because you can't really get that in the stock market. So you've got emergency fund, paying off your high interest debt. The next thing you can think about is, like, whilst you're working, workplace pension, is that make sure you've not opted out, that you're still in the pension, because then you can make use of that 3% from your employer, because all employers have to pay 3% of your pensionable income into your pension, and that's subject to scheme rules, and all companies have different rules. So you've got to earn like a minimum amount before you're entitled to a pension. So check that with your HR department. And then also check if they have matched contributions. So they'll pay more if you pay extra into your pension scheme. That's called a matched contribution scheme. And after that, then and once you set up a pension scheme at work, make sure that you understand where the contributions are going into, because when you set it up, normally at work, it goes into a default fund. So the default fund is like for everybody, it's just average, like vanilla. So we're all different ages, different wants, or different desires to retire at different times. So we've all got different individual circumstances. So it's up to us to go into that pension fund, see what's available, and select the one that's appropriate to your needs and your wishes. So then you move on to so you've got match contribution now. Then you move on to another thing you can think of. This moving on in pecking order is perhaps to pay into for the pension first. The pension has the maximum you can pay into pension is 60,000, and the high of the two, your 60,000 or your salary, and that's across all different pension schemes. So if you decided to then move to say set up a SIP, self-invested personal pension, SIPP, that you have to make sure that the total amount you do pay into that is the higher of 60,000 and your pay. So SIP is a good one to have, because you've got a more varied investment choices, and choose the ones where a platform where you look at the fees and the ease of use of the platform and the cost. So you got the SIP. Then moving on, if you're your own business owner and you're director of your own company, you can set up another type of pension called a SAS, SSAS, small self-administrated scheme, and that's for business owners and directors of companies. And with that, the good thing about that one is that you can loan back 50% of your pension pot to your company to help grow your business. So, and it's also got other options, like you can give third-party loans to another party, or you can invest in normal stocks and shares, stock market, listed companies in the stock market, stock exchange, and some scheme providers allow you to do option trading and buy into crypto using your pension pot. So yeah, that's another one to think about and look into. So that's the SAS pension. And also the SAS pension allows you to buy commercial property. So you've got an office, you're sort of paying rent to a third party, you can buy your own office for your own company, and then the rent goes, the rent you pay goes into your SAS. And then with that, with that, it's you can hold a commercial property within your SAS. That's another advantage for SAS. Of course, there is in every investment scheme, there's always the cons. The disadvantage with SAS is that if you then buy property, then maybe potentially a concentration of risk. You haven't got enough diversification because you've got property, in your, and you're then loaning 50% of your pension pot back into your business, and if your business was to fail, then that's your pension pot gone. So it's just bear the risk and be aware of the risk of concentration of risk. So moving on to the pecking order, so you've got your emergency fund, you've paid off your high interest debt, you've got your pension scheme, you've got pension going, and an ISA. An ISA is the individual savings account, and that you can pay up to 20,000 per year, tax year, into an ISA. And there's different types of ISAs. There's a cash ISA, there's a stock and shares ISA, there's a LISA, lifetime ISA, and there's another innovative individual savings account where you can invest in other companies. So you've got the ISA, and then if you've still got anything more left over in your pay packet, you can start investing with your kids, into your kids. So there's a junior ISA, and junior ISA you can pay up to 9,000 per year per child into a junior ISA, and that is allows you that within an ISA wrapper, it grows tax-free, income and capital gains tax-free, and then for the kids you can tap into it at age 18. You have to transfer that amount of money to them. So in the meanwhile, you're obviously giving them financial education so they can manage that pot of money at age 18 and start contributing, building on that one. So you've got the junior ISA, and also you've got the junior SIP. So you can actually set up a SIP for your from a child from its birth. I've mentioned that in another video I've made on my channel. So you can actually, by setting up a SIP for your child, you can put in 2,880, and the government will top it up by £720, making up to 3,600, and that you can start from birth, so from day one. So I didn't know anything about that until I became an actuary that was more financially aware about things like this. So setting up a SIP, you can actually then, from age 0, by the time they get to 65, they can be a pension, they can be a millionaire. So that's something to be aware of. If you don't put in the full amount, there's something you can start on. And with over the years, the compound it grows because the contribution grows, and also the interest on that grows as well. So it compounds over the time from 0 to 65, and that's how it becomes possible, by putting a small amount, that one can get to a millionaire and make your child a millionaire. So yeah, quite a lot of investments there. And after all this, if you've still got some more money, there's other things you can invest into, which is private equity schemes and the SEIS scheme and the EIS scheme, where by investing in these schemes, these ventures, you can actually claim back tax on the tax you've paid. The SEIS currently you can reduce your tax by the amount you put into it by 50%, and claim back 50%, and also of the amount invested in annual EIS, you can claim back 30% of the amount invested in. So yeah, hope you found this useful. Comment below if you've what your thoughts are on all the different ways of building up your retirement fund to retire early, and also please subscribe and share. Thank you for listening.